Crystal, in your tenure in the cyber insurance and reinsurance marketplace, how have you seen the use and reliance on cyber models change in that time?
I started off doing more of a mix of lines of business, so a mix of property and casualty reinsurance work. And working with property modeling outputs, things were pretty well defined by the time I got into the industry. So pretty standardized, and there weren't as many questions around the modeled outputs. Clients kind of were managing to the same return period based on rating agency requirements. So when I moved over to cyber, it was kind of a shock working with those CAT models and seeing how the industry interacted with them. I would say the models really started out as kind of more of a second point of view, maybe supplementing internal RDS scenarios. Cyber CAT just wasn't as understood as much as it is now, and there's still, I think, a lot of growth to happen there. But I've definitely seen that part mature quite a bit, and the models are now being relied on, I would say, more quantitatively. Clients are really looking at how to pick a risk tolerance, what return period should they be managing to. And then my job, of course, is helping to optimize reinsurance around that. As the models have become more mature and more credible, we're able to be more creative around reinsurance structures and look at things like catastrophe structures separate from non-CAT. Obviously, CAT bonds have come into the market recently. So I think the models maturing have just allowed for kind of more thoughtfulness and more strategy around managing the risk tolerance.
Thinking about Moody specifically, how have you seen the Moody's model evolve?
Absolutely. With Moody's RMS, I think the framework has stayed high level, pretty similar over the years that I've worked with the model. So Moody's RMS was dominated by malware, ransomware on the tail, which is something that continues today, and I think the industry, widely agrees on. I have seen the outputs become more granular, which has been really helpful for explaining results and diving deeper into results with clients. So things like being able to look at event level output, coverage level output, really just helps us to dig into those results and make the events more tangible for stakeholders in the cyber insurance industry. So that's been a big change. And then just, of course, refining the data that's behind the modeled assumptions. So I think the partnership with Moody's is big with that. That's a wealth of data that can be used to calibrate the model. And just Moody's, I know, is always updating their data behind the scenes, and they're pretty transparent around that, which is really helpful for us to understand.
How about the Moody's RMS U.S. cyber industry exposure database? How is that, what role has that played in helping to close the cyber protection gap?
I think that Moody's RMS is really uniquely positioned in the market with the background in property. It's able to get a comprehensive view of the economy based on the work on the property side, which is, of course, has a much higher take-up rate than cyber for businesses. And so having that economic exposure database as well as the insured exposure database allows us to model cyber CAT events and see for those specific events how much of the losses are insured versus uninsured. It's kind of astounding when you put those together. So actually looking at the tail, we saw that later in the tail, uninsured losses were about 80% of the economic loss. So that's a really high number. Even if there's conservatism in the model, that's still a big concern if 80% of the economy is suffering losses that aren't insured. I think it just sheds light on the need for more growth in the market and more thinking around cyber CAT risk.